subscribe. I beg, subscribe. Okay? Like the videos. I know these videos have been a blessing to you. Don't be selfish. Share with friends and family, even your enemies. Please click the subscribe button, click the like button, share on every platform you have access to. All right. So every call follows the same three act structure. So you're gonna have a lawyer or somebody's going to read. Somebody just actually, you don't. It's not a video call. It's a call. It's always audio call. So just going to hear somebody reading notes. The CEO is going to cover the strategy and the highlights. The CFO is going to cover the financial detail. All of these are fully scripted, and you're going to have Q&A sessions. So they're going to open the floor for investors to ask questions. So this is where experienced investors lean in. The Q&A session, and analysts are going to ask unscripted questions. I mean, this is not, you don't, the CFO, the CEO, they don't know what questions you're going to be asking them. So it's not like pre-worked questions. So they're just going to ask, all right, so we noticed that your sales dropped in January to February. How are you trying to accommodate that? How is that going to affect the end year results? So you're going to hear those kinds of calls. I've attended a couple of earnings calls, so getting used to it. So analysts are going to ask unscripted questions. They're going to ask how management is handling maybe some news, some breaking news that surround the business that might not speak well of the company. So maybe they're dealing with a class action, maybe they're dealing with a lawsuit. So that might be a good time for the management to discuss it as, okay, this is a way forward. This is how we're trying to tackle these issues, and this is how we plan to release detailed information to investors over time. So it comes a whole lot of transparency. So a direct, confident answer is what will help the company. So you don't want to be evasive. You don't want to be dribbling your investors at that moment. The two most quoted numbers on any call is the revenue, all right, the revenue and the net income. So yet it's like the top line and the bottom line. So revenue is the top line, net income is the bottom line. Net income is what is left after every cost, after every expense, every tax. Net income, what is left after every cost, expense, and tax. The bottom line is the profit left after costs, expenses. All right, I'll take that. So net income. Revenue is everything the company sold, which is the top line. Net income is what's left after every cost, every expense, every tax. So that's the bottom line. So why do this matter? Because they can move in opposite directions. So a company can grow revenue rapidly while burning cash flow on that growth. So if you notice some of these AI companies, AI GPU companies, many of these are businesses that are rolling out different AI solutions. They might be burning so much cash right now because they're just starting. They're just rolling out infrastructure. They're just rolling out services. They might be burning cash. So they are making money, but they're like tripling the rate of expenditure compared to the rate of enhanced earning revenue. So a company can grow revenue rapidly while burning cash on growth, or it can grow profits by cutting costs even as sales stall. So those are some key things you want to note with respect to revenue and expenses. Another thing to note is the earnings per share. So earnings per share takes total profit and divides it by the number of shares. So for instance, you have a $5 trillion company like Nvidia and a small cap, right? So it can be compared to the same per share basis. So if you look at my screen here, for example, we have a $10 billion net income. So you have 2 billion shares. So if you divide that, so that is their earnings per share. So if you divide $2 billion by 10 billion, so that's $5. So that means that's the earnings per share. So one thing to note here is that companies report both basic and diluted earnings per share. The diluted earnings per share assumes every stock option and convertible security becomes a real share. So it's slightly lower and more conservative. And that is the number analysts and headlines use for their reporting. Margins convert profit into a percentage of revenue. So this is how you're going to judge quality of earnings. Gross margin strips out only the direct cost of producing the products. So you're going to have operating margins, which is going to be subtracted from running the business costs, like research and development, sales. Then net margin is what is left after all is said and done, after spending so much. Gross margin. So two costs, right? Direct cost, operating margin. So how much do we need for our daily operations, for our annual operations? Then net margin. So it's going to, so whatever is left after running costs, salaries, vendors, everything that is left is net margin. So when you are listening on calls, earnings calls, listen for management commentary about margin direction. So margin direction is usually bullish. Margin compression raises questions. Margin direction bullish. Margin compression raises questions, and you have to be able to connect it to what we said earlier. All right. For instance, Nvidia's net margin is above 60%. That is humongous. That is astronomical for a hardware company. So that is why a company like Nvidia is valued very highly in the stock market. Another thing you want to pay attention to is the free cash flow, which is the cash left after running the business and investing in equipment and infrastructure. Free cash flow, that means it's sitting there. A company like Netflix, as of their last earnings call, they had $12 billion free cash. So that means that they can do anything with that free cash. They can acquire another organization. They can do a share buyback. That means they have money to invest further into the business, even after all expenses, salaries, bills, taxes. So what free cash flow funds includes dividends to shareholders, buying back shares, acquisition and investments, paying down debt, surviving downturns without borrowing. So they don't necessarily have to borrow. So they can use their free cash flow to perform all of these. So free cash flow is also what funds everything shareholders care about. For instance, Nvidia has roughly $119 billion of free cash flow. So that is what lets it write $10 billion investment checks without batting an eyelid, without blinking an eye. So another thing to note is the year-over-year numbers and the GAAP versus non-GAAP information. So year-over-year growth compares this quarter to the same quarter last year. So here it is like year-over-year. So that strips out seasonality. So if you say year-over-year, so that means this time last year, that means July last year. Where were we? Where are we right now? So sequential comparisons matter more for fast-changing businesses. For GAAP versus non-GAAP, companies report official GAAP numbers, but they usually headline adjusted figures that exclude costs they consider one-time. So sometimes that's reasonable, sometimes the same one-time cost appears every single quarter. Yeah, so you may not want to bother yourself with all of those extras. Analysts publish estimates before every quarter, and the average is called consensus. So you have to like consensus estimates. The results are judged against that consensus estimate, not against last year. So there's a need to beat the bar. So they say earnings beats. Oh, Nvidia beats earnings this season. Netflix beats earnings. Procter & Gamble beats earnings. That means results are above. So analysts were expecting that, Netflix earnings is going to be like $2 per share, right? Earnings per share. But because they were able to manage their accounts, they were able to save money. Now, earnings is now $4 per share. So that's double expectation. So they have beat earnings. In some other cases, it's going to be in line. So when it is in line, it means that, just on the line. Just on the line. Neither here nor there. And in some other cases, they missed their earnings. That means they had dealing with a lot of issues. Right? So those are indices you want to look out for when you are attending an earnings call. So guidance is management's own forecast for the next quarter or year. You see this one, this is sometimes we wonder that, this stock did very well. They performed excellently well. This company did very well this quarter. They made so much money. They were able to reduce their debt. And then they still sold off, profit taking. Or Wall Street was jittery and then they bailed on them. So sometimes what could be responsible for that is the guidance. So this is the company's own forecast for the next quarter or year. For instance, a company like Nike can say that, our guidance is that we expect to make this amount of money in the next 7 months, in the next 6 months. So guidance frames the future, and stock prices live in the future, because stock price is a claim on future profits. So we are projecting future profits of $10 billion, $2 billion. because a stock price is a claim on future profits and guidance is the freshest information about that future, it is important to pay attention to what the company is saying about forward guidance. So, 3 4 elements to pay attention to. Change this. So sometimes you hear, oh, they raised guidance. So we are lifting full year targets. That means we are bullish. Nvidia bullish. Nvidia bullish. Intel bullish. That means they are bullish in future earnings, future growth. In some cases, it might be just we are farming guidance. So we are saying, okay, our target remains unchanged. As of January, this was the target remains unchanged. So we are growing steady. Then maybe they kind of some challenges, for instance, when that during the period where the government increased tariffs across businesses, countries. So for some companies that have international exposure, so that might have affected their sales growth for the year. So in that case, they might say, oh, don't expect so much this year because of these tariff issues. So they might have to lower their forward guidance. We don't expect to make so much. If we make money, glory be to God. But we have told you ahead of time that, well, we may not make so much money in the next quarter based on the current financial climate, which is not so palatable for them at the time. So who are those on the call? You have the CEO, you have the CFO, you have your analysts, you have investors, you have the media. All of these people are on the call. So the reason why it is not a discrete meeting, it is not it's not like, oh, only a set of people can attend the call. This is for transparency. So calls are announced publicly in advance. Anyone can listen through a designated link. You can join. You're gonna have transcripts and replays. This is one thing I love about Robinhood. Robinhood makes it possible for investors to be able to attend earnings calls, and you are able to listen again to the replays of those meetings. You can even get access to transcripts of those earnings conversations. So for individual investors, this is genuinely empowering. On earnings day, you have access to the same primary information as a hedge fund. Hedge funds, those ones are managing billion-dollar portfolios. So you're going to have all of those kinds of analysts on the call. So ultimately, if you're attending an earnings call, listen like a pro. All right. You're going to have a press release. So read the press release first. Then compare results, judge against consensus. Compare results, compare guidance to estimates, not just last year. Then you also want to focus on the Q&A. So what are people asking? What are the most prevalent, most recurring questions in the Q&A section that might determine the trajectory for future growth of the company? Check the GAAP versus adjusted. All right. So what are the adjustments? What are they including? What are they excluding? So the adjusted figures. Ask what adjustments are they hiding. Then number 5, you want to be able to track guidance revisions across quarters. This is a trend of raises or cuts. You want to find out if raises or cuts is far more meaningful than one data point. And finally, language shifts. All right, listen for what changed in the language. So what disclosures are we hearing on the call? All right. So I want to introduce three stocks that you should be paying attention to during this earnings season. So number 1, Google. Currently Google is trading for, as of July 10, is trading for $357. All right. So it has a market cap $4.3 trillion. Google makes money through YouTube, through Google Cloud, Google Adverts, multiple streams of income. Has a PE ratio approximately 27. So this is a good company to invest your money because of the PE ratio. The next earnings is on 22nd. So now Google has been in the news for, they're trying to raise money for their data center, hyperscaler. So this might affect the outcome of their earnings call. So it depends on how Wall Street is going to react to their forward guidance. So pay attention. Now, so if there is a sell-off of Google, then that's where to pounce. This is something you want to invest in for a long term. Then there is ServiceNow. All right, ServiceNow has, so if you compare ServiceNow to Google, so ServiceNow is $112 billion market cap. Let me read something about ServiceNow. I think I have a note here. Yeah. So ServiceNow is set to report Q2 2026 earnings on July 22nd as well. So Wall Street is expecting 6 cents per share and revenue growth of $2.93 billion. So this upcoming report is driving investor interest and stock resilience. So it was badly affected in the last earnings call because they mentioned that the Middle East war unrest affected their sales because so they had some excuses for that, and Wall Street is unforgiving. So they didn't just sold off their stocks, dropped as low as $80 thereabouts. So currently, analysts have upgraded the share price, the price target. So Guggenheim upgraded to buy with $125 price target. So it has the potential of going as high as $125. Truist raised price target to $130, and other analysts are maintaining buy ratings. So ServiceNow is in collaboration with Accenture, Hitachi, to launch AI-driven managed security and infrastructure monitoring products. So it's a software company, right? It's a software company. What ServiceNow does is to engage in provision of end-to-end automation workflow platform for digital businesses. So it has a platform known as Now platform. It's a cloud-based solution that is embedded with AI and machine learning. Right? So that's where they make their business from. Has a PE ratio, 30 times. So 64. PE ratio, So look out for ServiceNow. So ServiceNow is making money. It's making a lot of money, and they have future prospects. So this is something you want to invest in on a long term. And finally, so you might be looking at this. Oh, this is $1,800. How am I going to invest $1,000 in a stock? Yeah, some stocks can be as high as $3,000. All right, it can be as high as $3,000. So ASML is like a monopoly in this case because of the kind of service they render. So ASML engages in development, production, marketing, sales, upgrading, and servicing. Only one company. So they do all of this for advanced semiconductor equipment systems. So part of what they do is lithography, metrology, and inspection systems. And analysts upgrades. So they have upgraded the price targets for ASML to $2,623. $2,623. I'm trying to get my maths together. So Bank of America has upped the price target to $2,345. So for me, I'm just looking forward to when they're going to do a 4 stock split, 1 to 10, 1 to 15. I would love 1 to 18 stock split. So usually stock split is just to make it more affordable for investors to have a share of that company. So if you buy at $1,800 today, that means if they do a 1 to 10 4 stock split, that means you're going to have 10 shares instead of 1. Still maintain the same value. It's just that you now have more shares. Okay, so this is a stock you want to put on your radar as the earnings call approaches. As a matter of fact, earnings is on the 15th of July, so you might want to keep an eye on that. Keep your ears on the ground. All right, so that's it. That's it for me. We'll see you on the next one. Take care.